Welcome everyone to our Sunday evening call, and well, actually it's Thursday, isn't it? So yeah, good start. So welcome everyone, and obviously we've had a very turbulent couple of weeks, and a lot of people have been very rattled by what's happened to UK government bonds because they've sold off so much, yields have increased so much. But look, in a way, this is a good thing because it now means that you can earn pretty good income from owning individual UK government bonds. You know, it's 4% in the yield curve from about 1 year all the way out to 30 years. So even at the short end of the curve, you can get pretty good yields now. And, you know, a couple of the conversations I've been having recently with investors is exactly that. You know, how can you buy individual government bonds, not bond funds, but individual government bonds in order to generate an income which is relatively safe? And the beauty of owning individual bonds is you don't have to sell them. You just hold them to maturity and earn the capital gain or loss and also the income, the coupon, which adds up to about 4% at the moment, all across the yield curve. So certainly at the moment, I think, you know, there are opportunities. Now, in terms of the recent stuff which is going on also, clearly we've had a very volatile week in the US equity market. We've had a massive 2-day rally. Then we fell back from that, and I think that valuations almost reached the long-term average for the forward PE for the US. And I think that represents fair value, not cheap, but fair value. And I'll be making a video which I'll release this Saturday talking about what I'm going to do about that, which you might find interesting. Now, for members this week, the explainer, which I do every week, they ask me to make a video, they vote on what they want, and I kind of make a video about that topic. It's about currency crises, of course, because that's what's at the front of people's minds. So I had a long explanation of what happened during the Asian financial crisis. So that's also quite interesting, but that's a members only video, so you have to be a Pension Craft member to see that. And the podcast, which was quite entertaining, I think you'll find it entertaining anyway. Many happy returns, which my co-host is Michael Pugh. It was quite good fun because what we decided to do was the 10 commandments of investing. So with each commandment, he dubbed it, so it sounded like I was the voice of God, which clearly I enjoyed. I thought that was quite funny. But obviously there are some very serious messages in there, some really good, simple rules to abide by and thereby increase your long-term returns. And I'm not sure what the compliance is going to be for commandments as opposed to advice, but we'll just have to see how the FCA treats that. Right, so let's start talking about questions. So we'll have an hour together. What we'll do is you can ask a question. If anybody's one of our YouTube supporters, which means you've got a little crown next to your name, we'll answer your question preferentially. So we'll answer your question straight away. Or if you ask a super chat, because clearly that pays us some money and we kind of favour the people who do that. And don't forget to share and like this stream and tell other people about it, because obviously that helps us too. So I can already see Talbot Sunbeamers popping up on the stream of questions. Thank you for joining us, Talbot Sunbeamer. He's one of our long-term supporters. And he says, I hope you're settling well in the new home. Yeah, I mean, it's great. You know, we live in Holmer Green now, which is just outside High Wycombe. And Teddy just injured his paw, actually, because there was a cat from the neighbour and he was chasing the cat and he bumped his paw, and he's been a bit sheepish since then. And then to kind of just, you know, make fun of him, I think the cat reappeared in the garden, but I didn't let him out. So if you hear whining, it's because he can see the cat and I won't let him out. Anyway, so let's get started on your questions. Now, Laura's got a document here where she tells me about the questions people are asking. And there's actually a question from Talbot Sunbeamer who says, mortgage rates at 6%, do you think that makes for a closer debate in the invest versus repay mortgage dilemma? Now, it won't surprise you to hear that I've had several power hours this week with people who are into buy to let, and this is the exact problem they're facing. Now, if they've locked in a rate which is preferable, which is pretty good, a very good rate, a low rate before the increase, so much the better. But for the people who are thinking of opening a new buy-to-let property and buying a new buy-to-let property, now it's probably not going to be as profitable as it was because of the debt servicing cost. And I think a lot of buy-to-let properties will probably, the supply of them will reduce. Now, some of the people who own these properties own them outright, right? So they've got a large investment. As income rolls in, they reinvest it into other properties. So they're in a great position because they're cash buyers. But for some, in fact, I'd say probably for the majority, that's not the case. And they have to fund it with debt. And that means that they're going to have to roll over that debt. And at a certain point, it's going to reset at a higher rate. And it may not be viable anymore, or at least the yield will be lower. And it may be that they can't make the people who are living there, they can't raise the rent enough to absorb the increase in the mortgage cost. So if you do require financing, a large loan to value to buy a property, I suspect for many people, they won't be able to afford to create a buy-to-let. So I think, it certainly changes all of the dynamics in the rental market. But in the invest versus repay mortgage dilemma, clearly it shifts the favour and it shifts things into favour of repaying a mortgage. Because if the return on equity, say, is 6% and your mortgage repayments are also 6%, then it's not really hugely beneficial to repay your cash which you've got. It's not beneficial to invest it in the equity market because you'd be almost as well off putting it into repaying your mortgage. So I think it changes a lot of the dynamics. It also means that equity markets are less attractive. So if yields are higher, so let's say you can earn 4% with 1 year UK gilt. So I just lend the money to the government for a year. I earn 4% at the end of it. It's risk-free. As long as I don't sell it, I just wait till it matures. And if the FTSE 250 is earning, say, 3.5% dividend yield, well, suddenly it's a lot less attractive. So you're thinking, well, is there going to be a big capital gain on the FTSE 250? Probably not. This is a rough period. So you've got a very volatile investment generating 3.5%. You've got a risk-free investment, a 1 year treasury, 1 year UK gilt rather, which is earning 4%. Clearly the equities become less attractive. So there are lots of consequences of this increase in the risk-free rate. And primarily equities less attractive, I'd say, is one of them. Also the dynamics of paying off your mortgage, debt suddenly becomes more odious. You don't want debt because it costs more to service, and that's going to have an impact on all aspects of investment right now, I think. So I think if you've got an irresponsible government which is incompetent or financially illiterate, it has consequences. And we've worked hard for the privilege of having low borrowing costs. If you look at the UK borrowing costs over the last 5 years or so, or 10 years, we pay less than the US for the 10-year point on the curve, for example. And recently we've had that cost of borrowing surge, and it's affecting everyone. It's not just the government, because we all have a risk premium which is added on top of the risk-free rate. So everybody in the country is paying the price of that incompetence and poor messaging from the government. So I'm very angry about it, I have to say. Anyway, let's move on. There's a super chat from Finance, Food and Free Time. You've asked before, actually. Thank you for that. How do you buy bonds direct? Well, if you're based in the US, you've got something which is called Treasury Direct, which is awesome. I only say that because we don't have one. I'm sure if you were a US investor, you'd say, oh, it's not great. But let me just show you Treasury Direct. And just kind of level of difference. Just so you can see the difference between the US and the UK. So I'm in the bottom left. Good. Right, so Treasury Direct. So firstly, it's a nice website, right? You can create your own login. You buy debt directly from the US government. It's just abundant when it comes to information. So these are the coming up auctions. So you can see what type of bonds they are. You can see the auctions that they've already been. And you can see the results of those auctions. So if you buy a 119-day bill, you can see that the rate would be about 3.8%. So much more attractive than it used to be. And there's also lots of information available. So let me just get rid of that. So stuff for teachers, lots of kind of educational material. Now let's contrast that with what you get in the UK. So this is the UK DMO, which does a similar function to the US Treasury. So they do have some stuff on the gilt market. So an introduction to gilts, a little bit about the issuance. They have some publications. But notice that if you're a retail investor, you can't buy this stuff directly from the DMO. So there's nothing like Treasury Direct. So the lack of information is something I was discussing today with a client. And it's really a stark contrast between the UK and the US. So let's say you do want to buy UK gilts. How could you do it? Well, some of the brokers have gilt sites. So let's look at Hargreaves Lansdowne, which is one of the more expensive brokers, but all of them should have something similar. So they do have a kind of, this is an iShares one. So let's have a look. Because I was just looking at it today, so I know they've got it. Bonds. Corporate bonds and gilts, here we go. So there is something here to do with gilts. So you can get a list of gilts. So if you wanted to buy one of these, you could actually get a list. And here we go. So we don't want corporate bonds, we want gilts, or we want index-linked gilts. So here they are. So you could sort them by maturity. And, if you wanted a 1-year one, you get one that matures in 2023. So here's September 2023. And if you want something like the yield, for example, I don't know if they plot that, but the yield is probably around 4%. I'm hoping. Where's the yield? So they've got running yield. Have they got yield to maturity? No. But anyway, you could calculate it. So there we go. I mean, you can buy individual ones, but it's just not as easy as it is in the United States. And the data is much harder to get. Something as simple as a yield on one of the gilt funds, for example. And we spent about 5 minutes with this chap today in a power hour trying to work out the yield on this gilt fund, and we just couldn't find it. So it is difficult for fixed income investors, I think, to get good information. So yeah, sorry it's turned into another rant. But that's how you do it. You go through your broker in the UK, or you go through the Treasury Direct in the United States. We've also got a super chat from Michael Brett. Thank you very much, Michael. That's really kind of you. And he says, what do you think the likelihood of Elon buying Twitter at the original offer prices? Despite trend to DB transfers into SIPs, is it time to think again about annuities in a rising rate environment? Oh, okay, that's an interesting point. So will Elon buy Twitter at the original offer price? I wonder if he'll actually go through with it now, or whether he'll find some other way of kind of wiggling out of it. I mean, it's so funny. In the FT today, Robin Wigglesworth, who writes for Alphaville, which is the kind of slightly less serious part of the FT, he came up with a list. I think it was a list of 5 ways that Elon can avoid having to buy Twitter. It was great. I thought that was quite funny. And I'm sure Elon's going to read it. So will he buy it at the original offer price? Not if he can avoid it. Because obviously, at the moment, I suspect it's come down a lot. Let's have a look. Twitter. I can't remember what the offer price was. It has had a bit of a rally. So this is what it looks like. So I mean, there's been a massive rally over the last few days. So how big was that? It's pretty chunky. Yeah, so that's a 22% rally. Incredible, because because of the offer. So people are obviously pricing in a fairly high probability that he's going to stump up and he's going to go through with it. So yeah, there we go. So certainly the market probability is pretty high. And if we knew what the offer price was, unfortunately I can't remember, we could work out that probability of the deal going through from the price, because you just do a linear interpolation between the price before the offer went through and then the offer price and then the actual price which it's at today. So if there was 100% probability, it would be at the offer price. And I seem to remember that is not much less than the offer price, about 52, but I can't remember. I'm sure somebody on the call remembers. Okay. Excuse me. Right. So back to your questions. The other question, which is also interesting, is another consequence of higher risk-free rates, which is that if you buy an annuity when you retire, remember what this means is you get a stream of cash flows until you die. The drawback is that stream of cash flows won't be inherited by your descendants, but you get that linked to inflation for the rest of your life. So from your point of view, it's risk-free. The big risk, I guess, from your point of view, is that interest rates increase massively after you lock in that rate for the rest of your life. But certainly at the moment, the lock-in rates are going to be that much higher. There will be a lag. You can bet there will be. But certainly they're going to reset higher, just like mortgages did. And that means that suddenly annuities are looking much more attractive. Whereas previously you'd think, well, I can earn 6% compounded for the rest of my life if I instead invested into equity. But if you're suddenly thinking, well, I can earn 4% for the rest of my life if I get an annuity, even if markets tank, well, suddenly that's much more attractive because it's also 4% linked to the rate of inflation. So that's pretty attractive at the moment, given how high inflation's running at, the rate of inflation in the UK, which is over 10%. So yeah, again, this is another one of the things which makes equity look less attractive as risk-free rates increase. Okay, so 54.2 for Twitter. So I mean, we could do a quick fag packet calculation. I like doing those. So 54.2. And then we can look at the price before, and I'll share my screen so you can see me, don't just hear me talking, so you can actually see what I'm doing. Oh, I'm already there. Okay, so let's have a look at that. So 54.2, and then before the deal it was roughly at 42. And the deal itself, you say, is 50. Okay, so the 54.2 is the deal price, and the current price is, let's call it 50. So pretty close to 100%. 50. Oh, that's bad. 50. So the probability would be 50 minus 42 divided by 54.2 minus 42. So that's pretty close to I'd say that's about 90%. Let's have a quick look. So 50 minus 42 divided by 54.2 minus 42. So, okay, 66%. So a 2/3 chance he's going to go through with it. So even now, people are saying, markets are effectively saying that, this thing might not go through. But yeah, I can kind of see why. Anyway, back to your questions. And I think we've got some more super chats. So Richard Watts, thank you for your super chat, says, are you willing to do a short explanation on how bonds are actually priced intraday? Okay. Where they're traded. There is a secondary market, but don't quite understand how things like US 10 is traded. So let's pull that up. So let's just talk about trading of US treasuries. So just like any market, if you're trading treasuries, there'll be brokers who specialize in dealing with US treasuries or UK gilts. There'll be market makers, and it's their job to create a market, just as it is for equity brokers. So if you want to trade with them, they have to trade. They can never say, no, I don't want to trade, but they will choose the price. So there'll be a bid and an offer price, and that's how they make their money. At the end of the day, if they have extra inventory, they'll probably lay off their risk. They want to end the day flat. They don't want to take a directional risk because that's a risk to them potentially. So, trading of gilts is very much like trading of equity. And it's a very liquid, deep market, unless it's stressed, as it has been over the last week. So if you actually read the letter from the Bank of England, what's interesting is they wrote to the Treasury Committee. So let me share this with you, because I couldn't believe this when I saw it. So this is the letter from the Bank of England to the chair of the Treasury Committee. That's Mel Stride. And it's pretty shocking. I mean, they show the size of the move upwards in gilts and then the kind of quick recovery once they started their huge asset purchase. And that's going to continue till October the 14th. And I'm slightly worried that when that happens, gilt yields are going to blow out again. But what's absolutely shocking is their description of why they had to do this, and how close to some of these very large LDI funds, liability-driven investment funds, were to becoming insolvent. So they talk about LDI strategies and how they have over $1 trillion invested in them in the UK, and how what happened last week was pretty shocking. So this is the value of the assets and liabilities of the fund before gilt yields blew out. And you can see that the assets were less than the liabilities. So this was a 20% underfunded pension fund. And that was the state of the market. In August, before this all kicked off, the average UK pension fund was 20% underfunded, which meant that its assets were about 20% less than the size of its liabilities. Now notice that the LDI bit adds a little bit more juice because it's leveraged. So that means they can have a little bit of stuff like equity, or in this case, they've got some gilts, which they've got via repo, and some just standard gilts as part of their assets. Now, the repo borrowing is what gives it the leverage. So what they show is that because the gilt yields rose, well, the liabilities actually fell, because if you discount them with a bigger rate, the value of the liabilities fall, which is good because the fund is now less underfunded. You can see the difference between the assets and the liabilities is smaller than it was. Woohoo, right? But what actually happened is the value of the capital, because of the cost of the repo borrowing, increased, the size of the capital shrank. And in some cases, the company's, the cushion was completely eroded. Or at least it would have been if gilt prices fell further. And that means that the bank counterparty, which is an investment bank, would take ownership of the gilts. So this was just an example. And then the Bank of England says, in practice, the move in gilt yields last week threatened to exceed the size of the cushion for many LDI funds. Remember, that's over a trillion in funds were impacted by this and had their cushions eroded by that huge move upward in gilts, due completely to the mini budget being incompetently communicated. And so they had to sell assets. What could they sell? Well, they tried to sell their gilts, but what really worried me here is that it actually says that they couldn't sell the gilts. Could not. Anyway, just have a look at the letter and you'll see that they say that the Bank of England says that some of these funds couldn't sell the gilts into an illiquid market, and they actually couldn't sell. So although I say that usually market makers have to make a market, they don't have a choice in the matter, clearly some of them must have stood back and said, look, we can't buy them. This is a one-way market. People just want to sell and we can't take the risk. So I think that was pretty shocking. But most of the time when things are normally operating, that's the way gilts operate. You pay the dirty price. That's the way it works. So there's a clean price and a dirty price. The dirty price is because of the accrued coupon between coupon payment dates. So let's say that the coupon's paid every 6 months and it's, 3%. So you get 1.5% twice a year. Well, let's say you're halfway into that coupon period. Well, if you buy the bond, you have to pay the dirty price because the person who owns it essentially is owed half that coupon. So it'd be half of 1.5%. So 0.75% would be owed to them. So you pay that dirty price. You give your counterparty in the secondary market the coupon they're owed and the value of the bond, the price, the clean price of the bond, plus the accrued coupon that gives you the dirty price, and then that's what you pay, the dirty price. And so that's how these things are traded. The reason why people use yield, which confuses everybody, is because if you want to compare two bonds, if they've got different coupons and different prices and different maturities, how do you know what you're going to get? Well, the yield tells you roughly how much you're going to earn. So that's why it's really useful. You'll see this if you actually trade gilts. You'll see that, you've just got this hodgepodge of maturities and coupons. If it was issued 20 years ago, the coupon's going to be like 4%. If it was issued 2 years ago, the coupon's going to be like 0.25% or something like that. So how can the yield be the same? Well, the ones with a small coupon will have a bigger capital gain to maturity. And the ones with a big coupon will probably have a capital loss between now and the time they mature. So everything adds up so that you get that 4%, which is pretty much what you're getting across the entire UK yield curve at the moment. So that's how these things trade. It's based on the price. Always think in terms of price because that's what you pay, the dirty price. And it's just the normal thing. If there's more supply than demand, the price goes down. And the UK government's going to be issuing in gangbusters because they've got tax cuts which they have to fund. And they've also got the very expensive energy price guarantee schemes which they have to fund. And so there'll have to be a huge amount of issuance to do that. Some people have estimated between 100 and 200 billion over the course of 2 years. So very expensive budget and plan. And there's going to be a lot of issuance. So the market's going to be swamped with gilts that people may not want to buy. So this isn't the end of this kind of liquidity problem with UK gilts. It's likely to get worse. And what was also interesting is it spread volatility into the US market. So US yields increased at the same time as UK ones. And then when the Bank of England intervened and yields fell and prices rose, the same thing happened in the US. So people said it was like the tail wagging the dog, because the UK market's tiny in comparison to the US one. So yeah, some really interesting stuff happening at the moment. Interesting, I say, but terrifying at the same time, because, you know, it's going to cause a lot of pain for a lot of people. And I don't think people realize how important gilts are to everything, right? Bonds are boring because people don't understand them, but it really underpins every asset and almost every aspect of our lives. Mortgages are the one we always feel most, because there we're borrowing money in financial markets. So suddenly people are learning about the swap market. You know, what sets your 2-year fixed rate? It's the swap rate. Oh, what's a swap? It's an interest rate derivative. Oh no, you know, it's quite scary. But it's forcing people to learn how the financial plumbing works. And, you know, if anything good has come out of this, I think that's it. You know, greater financial literacy. So that's great. You know, people will learn what a swap is, which is good. So back to your questions. And so, yeah, that's the secondary market, Richard Watts. And it's just like equity in a way. You buy, you sell, and there are market makers that you buy and sell from. The next question is from Adrian Cook, who says, so many blue chip stocks are down close to 50%, much more than the S&P, which is weighted towards a few tech companies. Yeah. Is there compelling value amongst those blue chips not heavily weighted in the S&P? Well, it's interesting. If you look at the US right now, let's have a look at the valuations for different chunks of the S&P. And let's use Yardeni to do that. In fact, again, you know, I was looking at a client with this today. And let me share. Okay. So this is great because it takes the S&P. So here's the large caps. So you can see that they're roughly at fair value, which is a 16 times multiple. This is data. Let's see when it was updated. So this is October the 5th. So that's yesterday. And you can see that the large cap valuation is roughly at the average, right? So not expensive, not cheap. And if we look at the mid caps, suddenly we see that it's at much lower values. So here the valuation is 11.8 times forward earnings. And if we go back in time, that's roughly where it was, not much above where it was during the very bottom point, the nadir of the big sell-off in 2020. So mid caps, you've got better value. It's not as bad as the financial crisis when it went down to an 8 times multiple. So, you know, still expensive relative to that, but compared to its long-term average, I'd say that's below. The long-term average, it looks like about 15. Currently, it's at about 12. If we look at small caps, suddenly, look, we're at a multiple of 11.2, which for small caps is very low. It is roughly where we were in 2020 at the bottom of the market, and it's not far off where we were at the bottom of the global financial crisis, where it looks like it was about 10 times. So as you go down the kind of from large cap to small cap, suddenly small caps look pretty reasonable in the US. And if we break it down in other ways, so the S&P 600 obviously is small cap. Again, you can see there valuations are much lower. And for mid caps too, much better than the S&P 500, which is dominated by those large caps. But to answer your question about the sectors, I think there is a sector document as well, but the chances of me finding it on a live stream are pretty low. Let's have a look. Yardeni forward S&P 500 sector. Let's try that. Oh, bless him. Thank goodness for Eddie Ardani. If someone lives nearby to him, please buy him a pint of beer for me. This is great. So, this is earnings per share. I'm hoping it's got forward P. Here we go. So, I mean, you can certainly break it down by sector, and the forward earnings right now. So this is what's forecast. So what I want is the forward price to earnings, not the earnings growth. We have the forward PE. Here we go, forward PE. So let's look at, I think it was specifically tech which you were asking about, wasn't it? Blue chips. Okay, well, I mean, it doesn't have a blue chip category, but certainly you can break it down by sector. And, that's probably the way I'd look at it. Is it cheap relative to history? And is that an opportunity? And, you look at the long-term average, is it well below? And, is it going to be out of favour for ages, or is this something that's going to come back? And in almost all cases, you'll see that it does go back to the long-term average. This history only goes back to 06. Ideally, you'd want more, but still, that's pretty helpful. Yeah. So here is exactly that comparison relative to that long-term average. So that's what you'd be looking for. Yeah. So, that's probably the way I'd do it. And you can look at price to sales, you can look at price to forward earnings, whatever, and assess value that way. But is there compelling value amongst blue chips? Well, I don't really do single stocks. I do it at the sector level, and then I'd look for a fund which gives me exposure to that level, to that sector or that part of the market. And if there isn't a fund which gives it to me, I probably wouldn't buy the single stocks. But if you are going to do that kind of thing, something basic like some kind of basic data platform would give you that information. A pretty good one which I've got dealings with is StockCard. I mean, they do pay for us, so I should say that up front. But, they do have, they sponsor some of our videos. But it is a good system. There's a really nice simple card for every stock, which tells you how it scores on various metrics, particularly for valuation. And you can do filters, all sorts. So that's quite useful for digging in and finding the value stocks. But like I say, I don't do single stock stuff, so I can't really help, I don't think. I know market. So Paul H, let me just go back to me talking. So Paul H says, I know market timing is frowned upon, certainly. It's one of the 10 commandments if you listen to the podcast this week. If we were to be overweight currently in cash short-term treasuries, what data points would you suggest looking at to determine a good time to a total index fund? So you're saying that you're overweight in cash and short-term treasuries, and you're thinking about moving to a total index fund. So I guess you're talking about moving to a total index equity fund. Well, valuation. I think valuation is a good thing to look at. Look at monetary policy. Look at what the Fed's doing. Are you fighting the Fed buying equity now? The answer is probably yes. But look, I talk about this in a video for this Saturday, so I'd really recommend you have a look at that because I kind of go over a lot of these valuation points. But it's a good question. Is timing worth it? Is macro timing still timing the market? And I think it is. I think, you can try and call which way these things are going to go based on monetary policy, based on interest rates, based on earnings forecasts. But most of the time, for most people, it's best just to buy, right? Carry on buying, invest as much as you can into the equity market for as long as you can and just compound for as long as you can. But if I had to look at when it's a good time to get in, this is what I'd look at. The valuation. Is earnings growth going to be good? What's monetary policy telling you? These are the kind of things I'd look at. Is credit conditions worsening? Is credit availability improving? Well, no. If you look at the SLOOS survey, the Senior Loan Officers survey, it shows that credit conditions are tightening. Look at credit spreads. If those are widening, then credit conditions are tightening. And that's also usually bad for equity. And inflation, if inflation's high, that's also bad for equity because it tends to erode margins. Usually when inflation's above 8%, as it is now, the earnings multiple, the forward multiple, the CAPE multiple, whatever multiple you look at, is much lower than it is today. So markets are clearly saying right now that we can look through the crisis, margins will stay high, everything's fine. Is that true? I doubt it, right? I think things are probably going to get worse, and I think earnings will probably suffer before inflation comes down, and certainly before the Fed starts to reduce interest rates. They're talking about keeping rates at 4.4 by the end of this year, 4.6 at the end of next year, and only then, the year after that, in 2024, will rates start to come down if you look at the dot plots from September. So, that's a pretty tight monetary policy. Maybe not by historic standards, but based on zero interest rates, which is what we're used to, it's pretty shocking. And the Fed's not going to run to the rescue unless something really bad happens, as happened in the UK. So, yeah, I'd say that's what I'd look at. Are things going to get worse? Look at credit conditions, look at monetary policy, look at earnings forecasts, see if you believe them. All of that should factor into your decision. And, if you're happy, then go and buy equity. So next question is also a super chat. Thank you, Ray. Lock an interest rate for mortgage for 2 or 5 years. 5. That would be my guess. It's not financial advice. But the thing is, at the moment, it doesn't look as if interest rates are going to go down again. And the reason why I say that is because this whole era of monetary policy across the world, where monetary policy was very accommodative, interest rates were low, it was essentially free to borrow, and at the same time we had fiscal austerity, where governments were basically cutting back on their spending. And that was the case for very many years after the financial crisis. What seems to have happened now is the exact opposite, where we've got fiscal largesse because we've shaken the magic money tree a couple of times. In the UK, they just keep shaking it now, even the Conservatives, and it's really spooked markets. In the US, you're being more careful with your fiscal policy. But generally, fiscal policy is eased and monetary policy has tightened. So kind of the opposite of what we've been used to for a long time. Now, what does that mean for interest rates? It means interest rates are higher. So more government spending means that the monetary policy has to be higher in order to combat inflation, which tends to run hotter when the government's spending more. But also when you've got higher nominal growth. If you look at nominal growth in the US now, it's over 9%. And that's what usually sets yields. So that's this is the new world we're in. No more free money and higher rates for mortgages as well as other rates, government bonds. So good for savers, bad for borrowers. So if you can lock in for longer, I probably would. Watch my video about what's going to happen to rates, which I did last week. I think what most people are predicting right now is rates are going to go up to a peak and then gradually back down, but not to the levels they were at before. And I actually put some numbers to that using a really simple forecast, which you'll see in the video. But if you're going to lock stuff in now, you're going to have to pay a higher rate. It might be worth waiting until the kind of peak in inflation is over, because then probably rates will come down a bit. So if you can wait for 2 years, because that's how long it's going to take, rates probably will come down. I know that's not much comfort, but so now if it really depends on what you can get. I've heard that some places 10-year rates are cheaper than 5 in some lenders, and that's purely due to the shape of the swap curve, which is where the fixes come in. So you've got to just be tactical about this and do the best you can. But personally, I would be locking in rates. If I was going to go for it today for a shorter period, and then after 2 years, I'd fix again, remortgage. At what I think will be lower rates. But that's just my guess. Nobody really knows. Next question, also a super chat from John Kearns. Thank you, John, for asking that. We're thinking of upsizing. Cool. House prices haven't abated, but rates are now high. Do you think it's worth waiting? If wait, just sit in cash. Love the show. Well, I love you too, John. I'd say it's worth waiting. Because you look at UK house prices, if you look at the latest nationwide house price survey, we're almost in double-digit growth still. And that's despite a huge increase in the cost of living, incredibly high inflation, energy bills doubling despite the energy price guarantee. So people have simply got less money in their pockets. And now that the cost of borrowing has surged by huge amounts, almost tripling for 2-year fixes, it simply means that most houses will be out of reach for many people. Now, there is a subset of house buyers who are cash buyers to whom all of this doesn't really matter. So they are kind of rate insensitive buyers. But there are still lots of buyers, particularly the first time buyers at the lower end of the market who, a lot of these houses are now out of reach. And I really feel for them because they've got a really raw deal. They've got negative real wage growth. They can't save for a deposit now. It's much harder to do that. And the cost of borrowing has increased. So you can see why many people feel hard done by. And it's justified, I think. So, but in terms of what to do with the money, if you're going to buy something in the next 2 years, don't risk it, right? So don't put it into equity because it's very volatile. It might fall in value. Cash is probably the safest thing, right? So, take almost no risk. If you are going to have to invest it, then very short dated government bonds would probably be the biggest risk I'd take with my deposit because it's just not worth risking it. Is it worth waiting? Yes. I'm almost convinced that house prices will come down. It's just a question of how much. But there's no way house prices can continue rising at almost double digits given the state of the economy right now and the cost of borrowing. It's just not going to happen, right? I am morally certain. There you are. I've said it. So I've said it on YouTube. I'm morally certain that house prices will correct. It's just a question of how much. Whether it's 10%, 15%. But yeah, we can't see price to income ratios at records for much longer. It's just not sustainable. So I'd wait, John, and I'd put my money into something very, very safe. There we go. So the next question is from Paul Waller, also super chat. Thank you, Paul. Do you know of any money market funds offered by Vanguard that offers a yield comparable with smaller UK banks' 1-year fixed rate bonds? No. They only have one money market fund as far as I know. Let's have a look. Now the yield on that's gone up, and that's good. Hasn't gone up much, to be fair. So let's have a look. What we offer, full list of funds, and we want their money market fund, and they've only got one. They finally got a filter, thank goodness. Money market 1. This is it. So the ongoing charge is tiny. Whoops, I bought it. Don't want to do that. So the ongoing charge is 0.12. Do we have a yield for it? Portfolio data. So the maturity, you can see the duration is tiny. It's all investment grade. And the yield is currently 0.5%. So remember that that's, for zero risk or very small risk. And, that's why the income is so low. But I suspect you're going to get more than 2% for, cash ISA, for example. So, or even a government bond. So let's have a look now at let's have a look at the yield curve. Because previously I mentioned that yields are very high now, which is one of the benefits of all this grief. So let's look at bonds and we'll look at the yield curve. So this is where the yield curve is right now. So what I said was that between 1 year and 30 years, the yield is almost flat at 4%. A little bit higher at the 5-year point and at the 15-year point and the 20-year. But the 30 year is 4.3. So the green line is the current yield. And you can see where it was just a month ago. So, you know, even for the 6-month part of the curve, you're earning almost 4%. So that tells you that, you know, the risk-free rates are absolutely tiny. That used to be tiny and no longer tiny. They're now 4%. So just by buying a 6-month gilt, you're going to earn 4%, which is pretty good, I think. So maybe that's the thing to go for. In terms of Vanguard funds, I don't think they've got a very short-term gilt fund. Not as far as I know, not from memory. Let's look at their bond funds just quickly to answer your question. Go back to Vanguard. We'll do their filter again. I really like this filter. I think it's quite good. All this to funds. And let's take a look at the fixed income stuff. Building my own portfolio. Let's go for bonds. Eventually. And let's go for UK. So we've got no currency risk. We'll go for index. Well, let's consider active as well. And what have we got? Have we got short dated? So you've got short-term investment grade bonds. So these are corporate bonds. So there you're taking credit risk, and it is risky. If equity sells off, these things could lose 10-15% if we get a big equity sell-off. Long duration gilts, you want to keep away from them. Investment grade, yeah, we haven't got anything which is kind of short-term, have we? Unfortunately. How about if we go to the US? No, again, you know, none of these have got short duration. So no, unfortunately. I didn't think there was anything, but that just confirms it. Sorry, no funds. Final question is from Abdul Khan, who is from Canada. So thank you so much for your super chat, Abdul. He says, on the note of S&P valuations, mainly forward and trailing 12-month PE, do you expect fundamentals to deteriorate further, and when? Right, so certainly at the moment what's being forecast is, I think it's 7.6% year-on-year growth between 2022 and 2023, and between 2023 and 24 it's 7.8% from memory. I did do a video about that. So it's fresh in my mind. But, you know, the average rate of growth over the 7 years before the pandemic was just over 6%. And now we're expecting over 7%, almost 8% growth for the next 2 years. Now, is that going to happen? Because forward price to earnings multiples are based on that assumption of really strong earnings growth, given very high inflation and, you know, a war on European soil. So I just think that, you know, that's not realistic. So I think things will get worse. In terms of timing, probably Q3, Q4 of this year, we'll start to see an erosion of margins. Also, I'd expect to see less spending, right? Because, you know, if US consumers are not spending because of high costs of shelter, you know, if the rents are high, prices are rising, inflation's coming down. Probably it's peaked now in the US, but it's still above 6%. So, you know, that's not a comfortable, it's above 8%, in fact, still. So it's not a case that inflation's gone back to 2, it's still above 8. And that's going to take money out of people's pockets. Less spending means less revenue, and less revenue means less profit. And margins will fall because the cost of production is also high, particularly because energy costs are high. So, I just think Q3, Q4 is probably when these things are going to hurt. So if inflation comes down a lot, if it surprises on the downside, that would push markets up. But it's a kind of race between that and margins being eaten away by higher input costs and fundamentals deteriorating, towards the end of this year. In fact, at the beginning of this year, I was saying that I thought that fundamentals would deteriorate towards the end of this year. So, I've held this view for a long time because, I just think that such high inflation has to have an effect on equity. It always has historically, and I suspect it's going to happen this time as well. So yeah, end of this year, beginning of next would be my guess when earnings are going to start to fall. Or at least disappoint, which is just as bad. Below that 7%, which is forecast. Final question, we've got 3 minutes. Finance, food and free time. Thank you for your super chat. We really appreciate it. With the pension funds having bought prime property at 3%-ish yields, once the rates go up, will they be asked to pay the difference in valuation? Ooh. And then crash the market? Well, I mean, the thing is, if they've bought it and it's out of the fund's cash, then it's not leveraged. It's not like they had to borrow to buy the property. These are real money funds. They get money through the door, they invest it into assets, and they pay the returns back to their investors, and they skim off a management fee. So, if they're going to be earning 3%-ish yields, they don't have to pay for borrowing, probably, in order to do that. They get money given to them and by their investors. So that's how they're funded. So they're kind of rate indifferent. So I think that rate indifferent part of the market, the people who are the cash buyers, but also a lot of these private equity companies, but also some hedge funds, I believe, are buying UK property, some of it residential, then, those people are probably less rate sensitive than, your average retail buyer like myself. We bought this with a mortgage, this house I'm sitting in right now. So we're the rate sensitive ones, and the rate insensitive ones are the ones which probably don't care about yields being higher, except for the fact that now they're probably going to have to generate higher income in order to make their investment attractive. Because if risk-free rates are above 3% and they're only giving 3% yields for their property, maybe they're going to have to think about how to make their fund more attractive. Maybe, if they run rental properties for retail, for normal people, maybe they have to raise rents to make it more competitive with risk-free rates. But yeah, interesting question. But yeah, I think they're rate insensitive is the answer. But, certainly for the UK market, I don't think there are enough rate insensitive buyers that house prices won't come down significantly. It's simply a question of how much and how long this sell-off lasts. But, at least in the UK, we're undersupplied for housing, and that tends to keep a floor on how much prices fall, because there's still demand and there's not a lot of supply. You replied. You reckon they're highly leveraged? Okay. Well, if they are highly leveraged, then they are price yield sensitive. But I think a lot of them are kind of real money funds. If it's a hedge fund, yeah, maybe they've got leverage. But pension funds generally tend to not have a lot of leverage or any leverage for regulatory reasons. Yeah. Okay. Anyway, so we've come to 8 o'clock. Thank you for all of your questions. I really appreciate it. And thank you for spending the time with us. Please do share this with other people. It helps us a lot. If you do enjoy our content, listening to our podcast, many happy returns. I'll be the voice of God right? It should be quite funny, and you'll learn something hopefully. And we'll speak to you again next month. Thank you all for joining us, and good luck with your portfolios.